In today's Market Pulse snapshot, the one thing I'm focused on in private markets is the increasing need for private commercial real estate debt, given the pullback in regional bank lending. In fact, this week marks exactly a year since the collapse of Silicon Valley Bank, which was then followed by additional failures of Signature Bank and First Republic. These failures caused concerns about the state of regional banks and the negative impact it could have on commercial real estate lending broadly. Now, regional banks, of course, hold 2/3 of the outstanding CRE loans, and as those mature, it's not clear that this sector will continue to be the lender to the CRE market that it once was. Indeed, looking at the recent data, we see that banks have been pulling back on CRE lending. The growth rate for commercial real estate loans for all banks is still positive, plus 1.1% as of the fourth quarter of 2023, but it is down significantly from the peak of 13.4% in the third quarter of 2022. In volume terms, if we look at the quarterly CRE lending pace, it has been running at a much lower pace in 2023 than in the prior 2 years, as you can see in this chart. If this continues, it poses a risk that the banks may not be willing to refinance a record wall of upcoming CRE maturities. Indeed, there's approximately $5.8 trillion in outstanding CRE debt, with roughly $1 trillion maturing this year and next. And given this weaker lending backdrop from the banks that we just discussed, those borrowers with upcoming maturities may need to look elsewhere for that funding. Now, fortunately, private commercial real estate debt funds have been eager to step in and provide capital because they're also looking at higher rates and wider spreads. For example, new issuances of senior CRE mortgages carry a coupon rate of SOFR, which is a floating rate, plus a 400 basis point spread, so yielding a total of 9% coupon at these rates on these loans. And CRE debt funds assets under management have grown to $270 billion as of June of 2023, up from $258 billion as of December of 2022, and up significantly from a decade ago. Now, these real estate debt funds are sitting on also a near record $77 billion in dry powder. And by the way, this is in addition to the commercial real estate equity funds, which hold $1.4 trillion in AUM with $470 billion in dry powder as of June of 2023. And those funds may be willing to step in and invest in equity in properties where prices have already sufficiently reset. So, while investors are absolutely right to worry about this funding gap for commercial real estate loans, given the regional bank pullback, and especially in the office sector, the good news is that private commercial real estate funds should be able to step in and help alleviate part of this funding gap, together with the other institutional pools of capital, such as sovereign wealth funds. And that's your one thing in private markets this week. But for more on this very important topic of refinancing the upcoming CRE maturities, be sure to check out our next segment, where I sit down with two real estate experts on the debt and equity side of the equation, and I ask exactly how and where they are stepping in given this backdrop.